Hey guys, welcome to an all-new episode of Basic Investment Terms. Today we're going to be taking a look at a stock split. We're going to look at what it is, why it's used, and how it can influence you. Now before we get into this guys, don't forget to leave me a comment down below. Tell me what you guys want to hear in any upcoming videos, and I will definitely add that to the list. Also, don't forget to subscribe. Now, a stock split. A stock split is when a company takes its outstanding number of shares and decides to fragment every single share into smaller shares. Okay, so it's just taking its outstanding number of shares and multiplying it by a predefined number. Now this number can be either 2, 5, 10, it can be whatever they want. It's just a predefined amount by which they're going to be increasing their outstanding number of shares. Now what kind of effect does that have on the stock? Well, first off, it doesn't increase the value of the company, it just makes smaller shares. So let's say a company has 10 million shares, they're priced at $10 each, and a company says, okay, we're going to have a 5-for-1 stock split. Okay, so we're going to take one stock and we're going to make 5 stocks out of it. So now instead of having 10 million shares, they now have 50 million shares, but instead of being worth $10, they are now worth $2. So 1/5 of their initial value, but there are 5 times more. So if you happen to own 100 shares of that company for $1,000, then your share price will decrease to $2,000, but you will have 5 times more shares. So it equals out. So they're worth a little less, but you have more. Okay, so it comes out to the same exact same value. Now another effect that can have is on the dividend. Most people think it dramatically increases the dividend because it's on a per share basis and you now have a lot more shares than you used to, but the reality of it is the share is the dividend they pay out is based on the yield. So the yield on that price will be the same. So let's say they give out a 5% dividend on a $10 stock. Well, they're going to keep giving you a 5% dividend, except this time it's going to be on a $2 stock. But since you have 5 times more, then it all equals out. So if it happens before the record date, if the stock split happens before the record date, then you have more shares, they give out less, but on a per share basis. So total amount of money you get as dividend doesn't change at all. So it's not affected by the stock split, nor the value, nor the dividend that you get. If it happens to happen after the record date, then it doesn't change what you would have had initially at all. You just get your initial amount per share. You get the full percentage on that $10, but you have only 100 shares and not 500 like you would have had if it happened before the record date. Now, why would a company want to do this? Well, first off, if you take a look now, if you just pause the video and go take a look at the stock price for Google or for Amazon, I believe nowadays they're around $850 each, which is a pretty hefty sum. And many investors, especially young investors, don't have access to that kind of capital to buy a full share of said company. Now, one of the reasons they do that is to increase attractiveness to investors with a lower capital. So they sort of renew investor interests by increasing the availability, if you will, of the stock. So now more people are interested, more people have the capital to go ahead and purchase that stock, and as another consequence, the outstanding number of shares has increased dramatically, which could make the stock a little bit more not volatile, but it could make it a little bit more easy to trade. So it would lower the ask and bid ratio, basically, is what it means. It would make it easier for traders to go in and out of the stock because it would increase the liquidity of that stock. So you're lowering the price, you're increasing the amount of shares. It makes it easier for investors with lower capitals to get in, get out. The stock now trades more fluidly, and it's an opportunity for future growth based on how much you're able to attract investors or smaller capital investors, basically. So it's sort of a way to renew attention and awareness on that said stock. So if Google were to have a 10-to-1 stock split, their price would go down to about $85 per share, which would make a lot more people potentially interested in that share, and which would make them, it could potentially be a catalyst for future growth. It's what you see often in blue chip stocks. When they get to a certain price, they say, okay, we're gonna dilute this down a little bit. We're gonna increase outstanding shares to make it affordable again, and to sort of start off fresh with just more shares this time. So that's potentially a few reasons there. So this is, in a nutshell, a stock split. I hope you guys enjoyed this video. I hope it answers a few questions that you guys have. If you have any questions that I didn't address in the video, just leave a comment down below. If not, don't forget to leave a thumbs up. Don't forget to subscribe, and you can follow me on Twitter as well, and you'll be notified as soon as a new video comes out. Cheers, guys. Have a good one.